Hey everyone, welcome back to Corporate Decoder, where we decode the language of big business, and tonight we're looking at Neumora Therapeutics. And trust me, this filing has a bit of a surprise in store. So what is the big news from Neumora Therapeutics Incorporated? Well, it is about their debt and how they're handling it. It seems they've been talking with someone called K.2, Health Ventures LLC, or K2HV for short. They had a loan agreement, and it looks like K2HV has the option to swap some of the money they loaned to Neumora, not with cash but with Neumora's own company stock. This is a pretty common move for venture debt, especially in the biotech world, where companies might not have a lot of cash on hand but are rich in potential. Now, for the interesting part, on the 17th of November 2025, Neumora got a notice from K2HV saying, "Hey, we want to convert $2.5 million of the loan into stock." They set a price for this conversion at $0.8774 per S-hair. Then a few days later, on the 20th of November, Neumora actually issued over 2.8 million shares of their common stock as part of this conversion. So what does this mean? It means Neumora has essentially paid off a chunk of its debt by giving away a piece of ownership to the lender. This whole transaction was done without registering the shares with the Securities and Exchange Commission, or SEC. They're relying on an exemption that basically says if you are selling securities privately and not to the general public, you don't always need to go through the full registration process. This is pretty standard for these types of deals with specific lenders, but it is important to note that these shares weren't offered to everyone. Let's quickly look at the stock. Neumora Therapeutics Incorporated's common stock trades under the ticker symbol NMRA on the Nasdaq Global Select Market. This tells us it is a publicly traded company, and this filing is all about how they manage their financial obligations. So this conversion of debt into stock is a pretty big deal for Neumora. On one hand, it reduces their debt burden, which is generally a good thing. Companies with less debt have more flexibility and can appear more attractive to investors. However, it also means they've issued more shares. When more shares are available, the existing shareholders' ownership stake gets diluted or spread thinner. If the company doesn't grow its value at the same rate as the share count increases, then the value of each individual share can go down. It is a balancing act. They're strengthening their financial position by cutting debt, but potentially at the cost of diluting current shareholders. Now, looking at the bigger picture for Neumora Therapeutics Incorporated, what does this tell us? They're a biotech company, and often these companies operate on funding rounds and loans from specialized investors like K2HV. The fact that they're able to convert debt into equity suggests that K2HV sees value in Neumora's future prospects and is willing to take on stock instead of just getting their money back. This could be a positive sign that the company is making progress towards its goals, or that investors believe in its long-term potential, even if it means a short-term dilution for existing shareholders. From a financial health perspective, it is always important to understand the context. Neumora Incorporated is in the business of developing new therapies. These kinds of companies often require significant investment, and it is not unusual for them to use debt financing that can be converted into equity. The key question is whether the company's underlying business is on a path to generate value that will eventually outweigh any dilution from these conversions. The value of Neumora's stock NMRA will ultimately depend on their success in developing and commercializing their therapeutic candidates. So, what is my take? Neumora Therapeutics Incorporated is doing what many growth-oriented biotech firms do. They're raising capital and managing their debt strategically. This debt conversion is a sign that their lender K2HV believes in the company's future potential and is willing to invest in it through stock instead of just debt. This move can strengthen their balance sheet by reducing debt, which is a positive. However, the dilution of existing shares is something investors will want to watch closely. If Neumora can indeed bring successful therapies to market, the dilution today might seem minor compared to the massive gains later on. The main risk here is always the inherent risk in drug development itself. A single clinical trial failure can set a company back significantly, but the company's direction seems focused on securing its financial footing while pursuing its ambitious pipeline. Alright, that is our breakdown of Neumora Therapeutics Incorporated's latest filing. What is your take on this debt to equity conversion and what it signals for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.